Welcome back, everyone. I'm making this video because more than you'd think, well, okay, maybe less than you'd think, but I promise it happens frequently. I get a question that amounts to, is it too late for Verde? And it's a complicated question, so I figured I would give my detailed thoughts in this video. So your regular reminder and disclosure. I own probably too much of the company that I'm going to discuss today. That means you should be skeptical, you should be extra skeptical, and you should need to think for yourself with any assessments made towards any investment. This is not investment advice. I still may be wrong. It's possible. This is just me thinking out loud. So why is the question of is it too late hard to answer and not just easy to say no or yes? Why is it video worthy? Well, that's because the situation has reflexivity in it. And I'll explain a little bit about why that is in a moment, but basically it can accelerate, the fundamentals can accelerate in both directions. And so trying to find a point in the middle is tough. Also, I know that given past experience, it's difficult to predict results on a shorter timeline. Over the medium term, it's very difficult to forecast things like price, growth rates, geopolitics, and things like that. So that could also lead to a wide dispersion of outcomes. And lastly, in the why is it difficult? Well, what is the timeline and expectations of the person asking the question? For example, do I think it's going to keep going at the recent pace versus do I think it's a good investment over a multi-year time horizon might have very different answers. So I will try and explain myself as, that's the point of this video. So the first thing I mentioned was reflexivity. And what I mean in this case is, let's say you have two scenarios. One where the market is very tight because of whatever, you could name a number of reasons, either lack of investment for a long time or geopolitics or whatever. Say the market's very tight. The other scenario is what if, there's overinvestment and the market becomes flooded. Well, okay. In the tight market scenario, you have low availability of supply and high price. Well, that type of environment would be, there's plenty of appetite to new and perhaps a different type of capacity. So if you're looking at growth in that environment, you could maybe grow by, this is just an example, 100 tons, and the margin might be higher, so call it $50 a ton. So the growth would be 5,000. These are very just exemplary numbers. Whereas in the loose market, there's plenty of material around, so people might be less willing to go to a new supplier for new sales. It might be more challenging to grow, and so growth might be, call it 50 tons, and because there's plenty of material around, the price is lower, so growth is 1,000. So here you have two different scenarios where just the growth aspect can change by the impact on the bottom line can change by a lot. Now, my stance has long been that if Verde offers a superior product, as it seems, they should eventually be able to grow and take market share from inferior products by offering the same product at a better product at the same price. Still, we have seen in recent markets that growth at a reasonable price is good, and growth at any price is terrible. So, is the price for Verde reasonable? And here is where I will start to answer by saying yes, depending on what can be achieved. Now let's rewind a few months to January, a time when the sector was doing better than it had been in years, but when the majors in the sector were 20 or 30%, the stock price was lower than it is now because there wasn't the current geopolitical tension and more threat of possibly shortage, and before Belarus Kali declared force majeure. So back then, the guidance issued was for 50 cents per share of earnings. Now, that's still including a large uptick from the year before. So it's not like nothing is priced into that guidance, so it's not like that guidance is necessarily going to be very easy to achieve. But management at that point thought that that was a fair number to give based on what they were seeing and their expectations. Now, I should note that even at that point, that guidance now was using numbers that were below the prevailing spot at the time. Now, I don't know the full extent of why that is. I assume they had reasons, but I don't know if those reasons were something like prior sales commitments, forward price assumptions, seasonality type of issues, or if they were wanting to impress shareholders or not wanting to overpromise. All of those are possible inputs in them making that assessment. But the market has remained strong, I would say, since, if not stronger, and there is potential to do more, but for the cases of assumptions, I would say that this is a significant step forward and needs to be treated as such. So it is saying that some of the strong market will be achieved already. Now, along similar lines of trying to nail down what a longer-term stabilized trajectory for the company looks like, I will say that there's still things that they need to show or prove to shareholders. This isn't, I think they're wrong. This is just as they mature as a company, these are things that they show that give more stability and more closing the gap of potential value to what they should actually be worth. And these things are that people need the market to recognize, or they need to prove that the market recognizes that their product is actually more value for the same price. Now, they also need to prove that they benefit from strong markets and can utilize the pricing cycle to make gains. Now, how you want to say that that will come out in results is, there's a few ways that you could argue it. But in a bear market, nobody wants to be a commodity producer because you're stuck selling at the market price. But in a bull market, there's a once in a blue moon where it really can benefit to become a commodity producer. And if you can benefit from that at those times, then it becomes worth it. Commodity producers have to earn their capex. Without that, then you see kind of what can happen to price, and in that if no one's spending money, the price will go up. That's just how it works. But anyway, they also need to prove that they can keep growing sales without harming operations or reputation in another way. And this isn't just me saying that. This is just me saying that it's not me saying that they've done that. I'm just saying that you need to be honest with your customers. You need your customers to like you, and you need to fill out what is expected of you, and you just keep needed doing that at a higher and higher scale, and sometimes that's hard. They also need to prove that they are effective allocators of profits, that they are as effective at allocating profits as they were at allocating capital from pre-profitability stage. They have done a very good job at managing limited resources when they weren't profitable, and if they can, but they haven't yet shown what they can do or would do with profits. And I'll get to this later of why this could be a big deal. Now, if and hopefully as they do manage to prove out these points and the growth that goes along with them, I do think there is still plenty of potential for long-term growth or value investors to enter from this point, even though prices will normalize at a level that is lower than today's level. Now, I should note that while I say this, I will also say that I do not think that the share price can keep going at the recent pace for an extended period into the future. That growth came from an acceleration in growth, acceleration in earnings, and an improving market at the same time. Now, it was also aided by a mispricing to begin with. For example, early last year, the stock price went up to $2, and then it fell to $1 and kind of stayed there for a long time. Now, in my opinion, that never should have happened, the fall, at least, because last year it was the most developed company it had been in, well, ever, and the share price didn't reflect that. Now, it has caught up for some of that, and there has been a lot of changing dynamics in the market. And so we're now back to a more reasonable price than it was in the past, but there is still some, if they can do that, then it will be higher type of stuff. So if you are thinking about this as an investment in a profitable company that can grow longer term, then I think there's still, if you're going to think you want to hold this for a decade and as they will fully prove out what they can do, then there's still possibility for exceptional returns. But if you're thinking by next year this will be $50, it's probably not for you. So the next reason that it's very difficult to evaluate an investment like this throughout a cycle is because that there is a cycle. And so putting aside any type of growth that you want to assign to volume or scale, profitability, things like that, there's also the problem that you are measuring these things based on a pricing cycle, where at the bottom of the pricing cycle you need to have a higher multiple because those low prices won't last forever. And then as you go through the pricing cycle, prices are low, you kind of still have a big multiple, but you need to contract it. But then when prices get high and then extreme, you really need to contract the multiple because these prices won't last forever. So what is a fair multiple? That becomes the next issue. If you want something, even though it's growing, to be valued at 10 times some extreme price and peak earnings type of thing, well, then you're really setting up for future disappointment because even though volume, or even though the companies can grow sales volume wise, their earnings may fall for a few years after that if the price normalizes, and then so people looking for significant growth will get disappointed or frustrated because they don't see the earnings per share growth, and the multiple can contract for reasons like that. So higher prices and very strong markets is kind of similar to more likely to pull forward growth, in that if the market is super strong, maybe it'll grow faster at higher prices very quickly, and then that might also slow as the cycle evens out. So let's have a look at a number of scenarios. So while all of these scenarios basically amount to complete guesses, this is my kind of basic base case, but obviously you can't have a base case like this without saying it's, you're bullish, and so this is my base case scenario. Okay, so by year end of 2022, I think that $10 to $12 makes sense. That target on a similar scenario takes you to 15 to 18 by the end of next year, and perhaps you need to extrapolate a bit more, but perhaps $25 by the end of 2024. So those are fair value type of thing then, so you need to discount accordingly. For example, if you thought it was absolutely guaranteed that they were going to hit that 2024 target, you could say, oh yeah, it's a buy at $20 today. Versus if you thought that you don't know, I mean, you want to take it day by day, and you're not even sure if they're going to make the 10 to 12 target. Well, then you might say, okay, it's a buy at $7, but not at $9 type of thing. So those are the base case numbers that I will give, and I'll say I base these targets on guidance type of volumes, but with lower prices and mean reverting on terms of the price, but keeping significant volume growth. So if you get both price and volume, you could easily beat, versus if you get both types of growth declining, well, then you'd have to adjust the other way. Now, I should note that this assumes, I'm looking at spot prices here and not realized prices. It also wouldn't shock me to see capital returns that don't really show up in the share price that I mentioned above. But if I was thinking about what some capital returns might look like, it might be like 20 cents a share in 2022, perhaps 50 cents a share in 2023 if the volumes are met. And I'm discounting this to a more sustainable pricing level, but I'll get more into my thinking on that type of issue later, but this would kind of continue to grow as volume grows over time, and kind of returning some of the capital to shareholders in a conservative way based on where future prices should be. So some people might say, and this might sound ridiculous to someone outside of commodities, but oh, there's only, we're almost there. You're just targeting about 50% upside between here and year end, assuming things work. Well, yes and no. So I'm not assuming that everything will work in this scenario. This is just me running on a type of guidance kind of from before any extra scenario, because there were things that were not included in that if they get to prove out, then that could mean some additional earnings to factor in. And those things that I mentioned before are currently price is well above the guidance figure, so if some of that translates through, that could be a bonus. Security of supply questions. So for example, we have seen export questions when it comes to fertilizer, and that is not an issue. It might be in some ways a benefit for Verde, because they don't export their fertilizer, they ship it locally, so that could be helpful. Belarus being cut off from the market. Belarus is a big potash producer, and they had issues even in early February. And then there's the Russian market export question. So there's a few more things that could change results. And what that has kind of resulted in the market is you saw that in a big move up of like 30% in Nutrien and Mosaic, and even some people buying shares in some juniors that won't produce for, let's be generous here and say 2 years. Now, basically, this type of move, particularly in the juniors, only makes sense if there would be a prolonged gap. And the buying in the Nutrien and Mosaic, for example, would again only make sense if the prices was going to, or the market was going to stay tight for some type of protracted period. Let's call it the busy season of this year or something, because you know, if the price is going to move for 2 weeks on news, then that's not really a reason why the biggest companies in the world in the sector should move up 30%. So looking at that scenario, what if there is a short or medium or extended term gap in the market where there's struggles to find availability of product? Well, on one hand, that would mean higher prices. On the other hand, that would mean that people are searching or more likely to use, well, spare capacity. So now here's where I will kind of rapid fire 4 scenarios that are where the results are so wide that you couldn't even get the ever given stuck in it. I miss those days. Simple problems. Anyway, I could make a light bear case where recently I said kind of set a kind of downside target of $3. Now, if they were to prove out basically the 3 quarters that end in halfway through the year to a relevant degree, basically if they were basically slightly behind where I thought they were, then they could basically prove out value to about $5 or $5.50, and that would become a very bearish scenario. But for now, let's say $3 or $4 is a lot of things go wrong very quickly, whereas the 550 is probably a light bear case. The base case, as I mentioned before, $10 to $12, assuming kind of a lot of reasonable things. They organically funded their capacity and have a little bit of cash left over, and I've spoken about this a lot, so let's just skip to the next. So for the more bullish scenarios, I'll name these the buy Mosaic and the buy Juniors scenario, because let's say there's a reason to be buying Mosaic or holding Mosaic at $60 a share or more. Well, that means that there is some type of issue in the market that will be allowing the producers to earn extra normal margins for a while. Now, the tricky thing for Verde is that will also mean contracting the multiple because of the margins being well above normal. However, if that happens and Verde can execute on what basically would amount to be the spot price for, or below the spot price, CIF, whatever, for an extended period of time, in that scenario, I don't think it's unrealistic to say Verde should be $18 by year end, assuming they execute and assuming they can. Basically, what works into this scenario is beating on volume while keeping up the price. It's not, I don't think that that's my most stretched scenario. Here is a more stretched scenario, not the most stretched possible to imagine, but if there is a reason to buy, juniors, then what that means is that there is some type of extended tightness in the market lasting perhaps years. In that case, the price remaining elevated for a number of years would mean A, more less difficulty growing volumes, and B, extended higher prices. So you would extend the multiple on that you were assigning to Verde because the prices were going to stick around for longer. And in this scenario, and I know this is a rather bullish case, then the stock might be worth closer to $30. And where am I coming up with this number? Well, that is would be using 5 to 6 times EBITDA, assuming that they were able to achieve the prices seen, and assuming that their margins were approximately $100 to $120 per ton. Now, that may sound like a lot. It might sound like not a lot. It depends how much you've looked at the company. But normalized, it is a lot. However, the current price in the market amounts to, if they are achieving the full price that they could be, this isn't aggressive given where the pricing is right now. So as you can see, there is a wide range here. This is why I don't envy analysts most of the time. I prefer to just invest in good possibility scenarios and just wait to see what plays out, because I have no idea which scenario plays out. And while I think that there's more upside in the short and long term than likely downside, we still can't know. But I should also mention that if I'm going to say a $10 year-end target, that doesn't mean that I think it should be $10 today, because there is 9 months left in the year and there's a lot for it to kind of prove out along the way. But if we're talking about scenarios or from an investment case, I'm perfectly happy sitting on it at 750 or wherever it is today and just kind of seeing what plays out, and just believing that a better scenario is more likely than a worse scenario in terms of reaching the target. Because in the end, a stock trading at 750 and earning 50 cents would be trading at 15 times earnings, which is, very reasonable for a company that can grow, and especially one that could grow in a what would amount to, after this year, a very capital light way. But I should also say that there's another possible scenario, and that is, maybe later this year the stock is trading around 18 and you're thinking, well, DV's an idiot. He said it's worth 10 to 12 this year, but it's 18. Well, he doesn't know what he's talking about. And then next year, based again on near-term earnings, you see the company is worth 18, and you think, okay, well, maybe DV might have, maybe he's not completely clueless. And then, of course, you could figure out the next year, when the stock is still trading or worth around 18, you could say, oh, never mind, DV's an idiot. Because that's possible too. And that would be the stock more so moving more in a possible cycle. But suffice it to say, I kind of normalized a number of things. And so the guesses that I made are assuming a number of things that are very likely to be proven wrong on both sides. Now, a few points that I believe are a bit underappreciated in the share price that we're seeing. And the first of which, and perhaps the most important, is that I believe there is material capacity above guidance that could help them be in a better spot to realize the benefits if a continued strong market tight market continues. So they have exposure to that type of thing. They also have sales in today's market, and this is kind of why I compared it to the juniors in a few slides ago, and that is because the juniors, I'm sure they have material underground, but the price moving in the short term doesn't necessarily affect them as much as a company that is actively selling. And so having, in theory, direct exposure to today's market and being able to realize the price gains as they do helps in the short term a lot more than just technically being a stock in the sector. The other thing is that growth defends multiple. So if the multiple that is paid is or might be paid seems a bit high for this type of company, you know, if they can grow into it, so that kind of cushions your risk, because, you know, let's say you had a company that was operating at full capacity and was going to make 50 cents a share in a good market. Well, you know, the market could become great and they could make $1, but the next year the market could become bad and they could make 10 cents. Whereas here, your trajectory is upwards in terms of growth over time. And the other thing is, in my scenarios, I don't use what I think is overly aggressive or overly far looking into the future, like targets. I don't use a target based on any numbers in like 2026, for example. So I try and limit it to a year or two forward in terms of trying to guess, because again, nobody knows what's going to happen tomorrow afternoon, let alone 2028. And last thing is that capital returns, whether that's a dividend and or buyback, are possible along the way to reward patience and reward the holding of the holding of the shares and waiting for the growth to materialize. And this is possible because a lot of the growth beyond where we currently are will be paid for this year. So in my base case scenario, for example, by the end of this year, they will have paid for about 2 more years worth of growth, meaning the free cash flow could be returned to shareholders as they grow into that. Now, what could very realistically effectively happen in a stronger market is there could be a bit pull forward of growth rate. And so that's why I didn't really want to include too much of that in this scenario, because over time it might normalize, and also over time I don't want to include, you know, if you look in a straight line of growth rate and we go from like 5 cents to 50 cents, it's not going to be $5 and then $50. So that doesn't really make sense to do that. Now, and this is why that I crushed the multiple. When we're talking about higher prices, you need to contract the multiple, but also why it's extremely important that the company can effectively allocate capital. If there's going to be some one-off event and the company were to be making, let's call it $5 in 1 year, not this year, next year, whatever. Let's say we're making $5 due to some one-off event. If they were to then say, oh, we're growing very fast, we made $5, our share price is $100, purely example here, so we could still buy back shares because we're growing very fast. Well, so let's say they buy back shares 20 times, not an unreasonable multiple for something growing. But then the cycle turns, and next year they make $2, and all of a sudden they're a company whose earnings per share are declining, and they bought back shares at $100 and now they're worth 20. Well, that was a lot of money wasted. Versus, let's say there's a one-off event and the shares price that in and say, oh no, but they're not going to do much more next year, so they're maybe only worth $20 because the multiple contracts. Well then, if the company buys back the shares with that $5, for example, they could buy back a quarter of the shares. And that would be very accretive, even though the next year they make $2 and they would have been worth 20, but now there's less shares, so they're worth more than that, and there's still long-term prospects. So that's why management, if they can prove that they're as effective at managing profits and where they put those profits as they were at the capital before they were profitable, that's why that could be a big differentiator over the long term. Now, also things that would work towards nailing down the gap, because it's a bit crazy, my scenarios, how wide the gap is between a bad one and a great one. But if we're narrowing it, what I would want to see to narrow it down and to have a better idea on more precisely what the company might be worth is, well, when they announce, if they talk about any visibility that they have on agreed upon sales in terms of volume and price going forward, because that reduces the two levels of uncertainty, really, of like, will they reach those numbers in sales, and what will the price be on those sales? Because, if spot price falls a lot, will those sales fall, realized prices fall a lot? If prices go up, will they go up? So agreed upon sales. What type of sensitivity do they have to a changing spot price going forward? I mean, that would be helpful to know. I would like to see that capacity increases and that sales continue, sales reach capacity, and what type of margins that would mean. I would hope that we get more full margins versus what potentially we could see. I hope to see that the cost per ton gradually decreases as scale is achieved and efficiencies are reached. And, it's always would be very nice to see beats and raises in terms of guidance. And, guidance is kind of like the Price is Right in terms of the best guidance is probably as close to reality as possible, but don't go over. I don't know what entirely how aggressive they were being in their assessment, but it would be very nice to at least meet or beat guidance on a regular basis, but not to have guidance kind of be so low that there's nothing to do but beat, if you know what I mean. So in terms of what I believe would be best for shareholders, long-term shareholders of the company, I think it would be very healthy to consolidate around this region, plus or minus, a few cents, for a while, for a few months even. And now that's to say that it would be helpful longer term, technically and fundamentally, to kind of put in okay, this is where we are worth at this point, and as the company shows that they are worth more, that they can grow the sales, that they can execute on plans and on what they hoped, well then we gradually move to higher levels where we kind of where the market decides, okay, now they're worth this for now. What I hope to see, or what I think is possible but perhaps not necessary, is some type of dividend in Q3 or Q4, perhaps next year, I don't know, but at a level that is low but sustainable. something where if the price goes to a low level, they wouldn't have to cut the dividend and would still have the ability to have capital for capex when needed. So, for example, they could fully pay out what they would earn at utilizing less than capacity at a low price level, because they would, in order to reach the capacity, in order to get to future capacity, they would grow sales from there, and that would free up some margin. Also, what I would do is I would grow that dividend kind of in line with sales and use kind of surplus capital or surplus earnings for either capex or buybacks when the price warrants it, or a special dividend when the price does not warrant it. So that's basically all. Again, not investment advice, but I do think that a properly reasonable sized position, so unlike me, is still probably worth considering at this point. Now, of course, these numbers are, very wide and will be tweaked as more information comes in, but this is just kind of how my thinking is today. What I think happened is the company had a bit of a recognition moment in the market that, oh wow, this is a real company now. This is a company that should be earning money going forward and could eventually be paying some of that money to shareholders, and it's not just a junior anymore. Now, this came with some expectations that it now has, that it probably weren't being priced in before, but now there are some expectations. But there is still plenty of room for them to beat and exceed those expectations over time as they prove out what they wanted to do and become. So that's how I think about the company today. And is it too late? No, I don't think it is. But is it going to go parabolic tomorrow? No, I don't think it is either. So with that, I wish everyone a great day, and until next time, wish you the best.